Welcome to this introduction to Chapter 5, Capital Accumulation and Growth. And this chapter is about the long-run growth of income and why some countries are richer than others. And this is a big topic, and we will just be able to give a brief introduction to this topic. I am Nils Gottfries, the author of the book Macroeconomics. And the purpose of this presentation is to give a quick summary and introduction to this chapter. So in chapters 2, 3, and 4, we built up a macroeconomic model. We looked at the supply side and saw what determines the natural level of production. We looked at the demand side, consumption and investment, and we explained how the real interest rate is determined in the long run. We defined the natural rate of interest as the real interest rate that makes demand equal to supply in the macroeconomy. But in all this analysis, we took the capital stock as given. We said that for a given capital stock, when unemployment is on its natural level, and we have a certain technology, then there is a certain long-run level of income or natural level of income. But that is for a given capital stock. And what we do in this chapter is that we allow the capital stock to change over time and see what happens to income in the long run as the capital stock changes. So the question is, what factors determine the capital stock, production, and the real interest rate in the very long run? In order to analyze this question, we are going to consider two different cases. We start with an economy with a constant population and a constant technology. And we look at that economy, and we'll find that in such an economy, if you start with the low capital stock, you will accumulate capital, but eventually that accumulation will stop and growth will stop, and you will end up with a constant level of production and capital stock. And the key factor here is the decreasing marginal return to capital for a given workforce. And that will then lead us to conclude that in order to have long-run growth for, say, 100 years, then there must be something more than just capital accumulation. There must be growth in either population, or there must be technological development, or both. Otherwise, you couldn't have growth for centuries. And then we are going to use our theory to discuss why some countries are richer than others. So we start with a given population and technology, and we simply start by guessing that there will be some kind of long-run equilibrium where there is a real interest rate R bar. So let's start there. Later we can figure out what that interest rate will be. So we still assume that firms choose investment so as to maximize profit, and that means that they will choose a capital stock that fulfills the profit maximization condition, that the marginal product of capital divided by 1 plus the markup minus the depreciation rate equals the real interest rate, or the required return on investment. And of course, that means that if technology and employment are constant, then this implies a constant capital stock. So we immediately see that the capital stock should in the long run go to some equilibrium level for that interest rate. But what about the interest rate? Well, if we are in a situation where the capital stock and production are constant, then of course consumption must also be constant. Consumption cannot be growing in this situation. And then we can use the first order condition for consumption to figure out what the real interest rate will be, because the first order condition for consumption says that the marginal utility of consumption today divided by the marginal utility of consumption next year divided by 1 plus the subjective discount rate should be equal to 1 plus the real interest rate, which is the relative price of consumption today in terms of consumption next year. And now if consumption is constant, then of course the marginal utility, the U prime C, is the same today and next year. And then we see immediately that this condition says that the real interest rate must be equal to the subjective rate of discount. So that was it. We have now figured out that there is a long-run equilibrium where the real interest rate is equal to rho, and then the capital stock is determined by the profit maximization condition. And the intuition, of course, is that the more impatient the consumers are, the higher real interest rate they require in order to keep consumption constant. Because if the real interest rate is lower than the subjective rate of discount, then consumers want to borrow so as to consume more today than tomorrow, but that can't be the case in a long-run equilibrium. So therefore, the real interest rate must be equal to the subjective rate of discount, which reflects the impatience of the consumers. And here we'll illustrate this long-run equilibrium. We have the capital stock on the horizontal axis and the real interest rate on the vertical axis. And then we have R bar, and then we have the long-run capital stock denoted K star, which is what capital will go to in the long run. But what happens if we start with a lower capital stock? Well, if we start with a lower capital stock, we will have a higher return on investment because the marginal product of capital is going to be higher. And that means that there will be a stronger incentive to invest and to save. So if we start with K0 here, then there will be more investment and savings relative to the capital stock, and the capital stock will grow. And similarly, if we start off with a very high capital stock, the marginal return on investment is low, and there will be relatively little investment, and the capital stock will fall. So that's what we say here. With a low capital stock, there's going to be a lot of savings and investment. So that means that in the long run, we end up in a situation where the capital stock is not growing. So this theory tells us that we can have growth for a period. If we start with the low capital stock, there will be growth as we approach the long-run equilibrium level, but then growth will stop. What does this tell us about income differences between countries? Well, to find out, we use the assumption of constant returns to scale. So remember, constant returns to scale says that if we double the production factors, we double production. And when we have constant returns to scale, we can write the production function in a slightly different manner. We can define En as the effective number of workers. Remember, we have that E is the technology factor, and a 10% increase in E is as if we had 10% more workers. So in that sense, we can think of En as the effective number of workers. Now, with constant returns to scale, we can rewrite the production function so that the production per effective worker is a function of the capital stock per effective worker. So this is a little mathematical trick that you can read about in the book. So we define little k as the capital stock per effective worker. And the point here is that production per effective worker depends on capital per effective worker, independent of the size of the population. It doesn't matter if we have a country with 10 million people or 100 million people. What matters for income per capita, that is the capital stock per effective worker. And this, of course, is a consequence of constant returns to scale. And that means also that the marginal product of capital is also a function of the capital stock per effective worker. So we write it as little f prime of k. And now we can draw the same figure, but instead of having the capital stock on the horizontal axis, we have the capital stock per worker on the horizontal axis. And again, we see that there will be a long-run equilibrium where the marginal product of capital divided by 1 plus the markup minus depreciation equals the required return on capital. So this just shows the same picture again, but now in terms of capital stock per worker. And here the point is that all economies should converge to the same long-run level of capital per worker, independent of the size of the country. And that in turn means that all countries should converge to the same income per capita. So, constant returns to scale implies convergence. For a given population and technology, the capital stock and production will reach long-run equilibrium levels over time. In this long-run equilibrium, we have no growth, and two countries, if they have the same technology and the same subjective discount rate, they will reach the same capital stock and real GDP per capita in the long run. So we can conclude that with constant population and technology, there is growth during the adjustment period if you start out with a low capital stock. But to explain growth in the very long run, we have to have population growth and technical development. So the ultimate driver of long-run growth over, say, 100 years is really not capital accumulation. That's part of the process, but the underlying driving force must be population growth and technical development. So we now go to our second case, where we, instead of assuming constant population and technology, we assume that population grows at a constant rate, little n, and the technology improves at a constant rate, little g. And these are again measured so that if there is 2% improvement of technology each year, then little g equals 0.02. So again, we solve it in the same way as before. We just guess that there is going to be some constant real interest rate on a long-run growth path. And of course, the profit maximization condition is the same as before. So again, capital stock per effective worker is determined by the profit maximization condition that we have seen now many times. So we must have a long-run equilibrium where capital per effective worker is constant, because the marginal product is a function of capital per effective worker. And if capital per effective worker is high, then the marginal product of capital is low, and the other way around. So there we have a long-run equilibrium where capital stock per effective worker is constant, and we'll soon see what that means. But let us first ask, what will the real interest rate be? Well, again, you can use the first order condition for consumption and show that the real interest rate is going to be determined by two things. The subjective discount rate, rho, as before, and the growth of technology, g. And if we assume a specific utility function, the log function, then we get that the real interest rate is equal to rho plus g. So here we have learned a very important lesson that in an economy with high growth, the real return on assets is going to be high. That makes intuitive sense. In a growing economy, you have a high return on investment. One way of stating the intuition for this is the following. If consumers know that income is growing, then consumers want to smooth their consumption, so that increases their willingness to consume. Basically, if you know your income is going to go up, you'd like to borrow now in order to consume based on your expected future income. But of course, that is not possible. We're talking now about the closed economy. There is a certain amount of goods available for consumption. So to counter this incentive of consumers to consume based on their expected future income, you have to have a high real interest rate to make them save and invest, because otherwise you won't have any growth. So this expectation about high future income implies that the real interest rate in equilibrium is going to be high. So the real return is related to the growth rate. In a closed economy, in an open economy, it's a different matter. In practice, you can think of an economy as being somewhere between a totally open and closed economy with respect to the rest of the world. So what does it mean that the capital stock per effective worker is constant? Well, it means that K over AN is equal to some steady state level. So we call this a steady state because it's not an equilibrium where everything is constant. It's rather a steady growth path, a growth path where things are growing in a balanced way, as we will see. And therefore we call it not equilibrium but steady state. So if K over En is a constant number, little k star, that means that K is equal to K star times En. And we can now use our rule of thumb for growth rates to figure out that the growth rate of the capital stock is the growth of technology plus the growth of population, that is G plus N. And similarly for income. So income per effective worker is going to be little f of K star. Again, that means that income is going to be growing at the rate G plus N. So what did we find? We find that on this balanced growth path, or what we also call steady state, capital per effective worker and production per effective worker are constant. Capital and income grow at the rate G plus N. So the intuition is very simple. The driving forces for growth are technological growth and population growth. And that is what drives the growth of capital and income. And capital and income must both grow at the same rate, G plus N. And what about capital per worker and GDP per worker and consumption per worker? Well, they are going to grow at the rate G. That is easy to figure out, that they will grow with technology. So this is a steady state growth path. And this theory says that if countries have access to the same technology, they should converge to the same growth path in terms of production per capita. Now, if you look at the real world, we are far from a situation where all countries have the same GDP per capita. If you compare the USA and India, you see that India has a GDP per capita which is less than a tenth of the GDP per capita in the US. And Zimbabwe is far below that. And if you take European countries like Sweden, Germany, the UK, France, they are a bit behind the US. And then we have China somewhere in between. So there are very large and very persistent income differences between countries. And those very large income differences, from the point of view of this theory, you could say that they are quite surprising, because the theory says that we should have convergence. Two countries with the same technology and discount rates should converge to the same income per capita. So if one country starts with less capital, it's going to be poorer. But in that country, the return on investment is very high. So growth should be high, and over time the country should catch up with the richer country. So obviously this is not happening, at least not very quickly. There are very large and persistent income differentials. So why is that? Well, if we look at this theory, it points to capital as a key factor, that countries with a low capital stock will have a low level of income. So maybe some countries have low incentives to accumulate capital, or they have been unable to accumulate a lot of capital, and that's why they are poor. And if we compare capital stocks and GDP per capita across countries, that certainly explains some of the income differences between countries, but far from all the income differences. So here we have the capital stock per capita on the horizontal axis and GDP per capita on the vertical axis, and we have fitted a production function to the US data. So the dot on the line is the US. And then you see that, yes, there is a positive correlation between capital stock per capita and GDP per capita. So we can explain some of the income differences by differences in capital stocks. But you also see that most countries are below the line, which means that there are differences in GDP per capita which are not explained by differences in capital stocks. You can then say, well, what about what economists call human capital, that is schooling? Isn't that a factor? And we're not going to discuss that here, but it's discussed in the chapter that we can try to measure the amount of schooling that we have, the education of the population, which presumably affects production. We can measure the differences in education by the number of years people have been going to school in the adult population. And we can try to say how much of the income differences can be explained by differences in capital stocks and schooling. And then we get this picture that on the horizontal axis you have the predicted GDP per capita, where you take account of capital stocks and schooling. On the vertical axis you have GDP per capita, and you see, well, there is clearly a positive correlation, but there are also large unexplained income differences. So yes, capital and schooling matter, but also other things. Studies suggest that at most 50% of the income differences that we see between countries can be explained by differences in physical capital stocks and schooling. And that leaves about half the income differences to explain by other factors than capital and schooling. And of course, we may also ask, why is it that countries do have different levels of capital and schooling? So this analysis leads to a lot of questions about how there can be so large income differences between countries. You could also say, well, okay, income differences are large, but maybe we are on a path to convergence. Maybe the poor countries are growing fast and catching up with the rich countries. Well, there you have a rather mixed picture. So this graph shows on the horizontal axis GDP per capita in 1980, and on the vertical axis the growth in GDP per capita between 1980 and 2009. And what you can see here is that the countries that had a high income already in 1980, those on the right side, most of those countries have a kind of similar growth rates, about 2% per year. But if you look at the countries that were really poor in 1980, the ones on the left side, you see there's a very mixed picture. Some of them have fantastic growth rates, and some have actually had negative growth rates and become even poorer and have been lagging behind instead of catching up. So you have a very mixed picture in the world. Generally speaking, you could say that many countries in northern middle Europe have similar income levels. For example, the UK, France, Germany, Sweden, the income levels are quite similar, and also the growth rates are quite similar, about 2% per year. So there seems to be that those countries have converged to some kind of similar steady state growth path. Also, if we look at Europe in general, we could say that there has been some convergence, that those countries in Europe that were relatively poor in the 1950s have had reasonably high growth and caught up with the others. I'm thinking of, for example, Portugal and Spain. They have actually caught up with Northern Europe quite well over the last few decades. So in Europe you can see some convergence. If you look at poorer countries, there is much more divergence. There are countries that are catching up quickly and others that are in fact falling behind. And there are also great geographical differences. So many Asian countries have in fact had very rapid growth over the last couple of decades, and they have done a lot of catching up. They seem to be on the way to converge to the high-income countries, but many African countries have been falling behind or had very poor growth over the last few decades, although in the last 5 or 10 years there have been quite positive signs in Africa, with some countries showing quite high growth. So there are big differences between countries, and you could ask, where do those differences come from? The popular argument in the public debate is, well, it's overpopulation, it's lack of natural resources that explains why countries are poor. Well, that's a pretty bad theory, because if you look at the high-income countries, some of them are very highly populated and have very little natural resources. Think of, for example, the Netherlands or Japan. Both those countries are densely populated and they don't have much natural resources. Still, they belong to the high-income countries. Natural resources are traded. You can buy materials in the world market, and you don't need to have them in your country in order to be rich. And we know from the national accounts that agriculture plays a very, very small role in the high-income countries. It's only about 1 or 2% of GDP that is produced by agriculture. So clearly, having a lot of people per square meter is not in itself something that prevents you from having high income. So we end up talking about institutional factors, or sometimes economists talk about social infrastructure. Clearly, institutional factors play a very important role in both creating incentives to accumulate capital and also incentives to use the resources that you have in an efficient way. If you think about what you need in a modern economy, you realize that there are a lot of things that have to be in place in order for the economy to work well. You need the public infrastructure. You need things like transport system, communication system, you need education and healthcare, where the government is typically involved to a large extent. And those things have to work. The government has to do its bit. Regulations have to be efficient and promote competition, not prevent competition. Labor market and product markets must be functioning well, which requires law and order, and you must be able to enforce contracts, and you must have, above all, law and order. And many poor countries are characterized by corruption and lawlessness, or even conflicts and wars. Some of the really poorest countries suffer from civil wars or social unrest that effectively prevent those countries from developing. So clearly there's a role for other social sciences here, political science, sociology, to explain what is going on in these countries. And if you look at research today, there is a lot of interesting integration between economics and political science, where researchers are trying to understand the role of institutions for the economy and what makes good institutions and bad institutions, the role of media and other factors. So there are clearly a lot of questions that we do not have time to discuss here. You can read a bit more in chapter 5 in the book. Good luck with your studies of chapter 5.